calculation of ERR, we need profits available for equity shareholders divided by total paid up equity capital into 100. So this is the formula to find the ERR. All this additional information is given. So we have to calculate the value of shares as per the intrinsic value as well as on the basis of the yield value. When I add all this, I get 92,500. So average profit I divide it by the number of years, I get 30,833. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session 2 of Unit 4, we will be working out 2 problems based on valuation of shares. Now, here the problem 3 is, Apollo Limited has 50,000 equity shares of rupees 10 each and 40,000 12% preference shares of rupees 10 each. Now, the equity share capital. Now, what is the equity share capital here? 50,000 into 10. That is 5 lakhs. Next, they also have a preference capital here. So, the preference share capital equals 40,000 into 10. That is 4 lakhs. Yes. And they have also given us 12%. Now, what does this 12% stand for? 12% stands for the rate of dividend. The company transfers 10% of the divisible profits to reserve every year. So, 10% of the profits is transferred to the reserves. The expected profit before tax is 5 lakhs and the rate of tax is 30%. The normal rate of return is 12%. Compute the value of equity shares under yield method. So, this is the problem. Now, based on this data, we have to calculate the value of shares. Now, the first thing is we have to take the profits. What is the profits available? So, in the solution, so we write profits before tax. Now, what is the profits before tax given? Profit before tax is 5 lakhs. So, I take it as 5 lakhs less tax. Now, tax rate is given at 30%. So, what is the rate of tax? 30%. So, the rate of tax is 30%. So, on 5 lakhs, I take 30%. So, it will be 5 lakhs into 30 by 100. So, it comes up to 1,50,000. So, I write it as 1,50,000. So, this is profit after tax. That is 3,50,000. Profit after tax is 3,50,000. Now, what is the other adjustment we have? The company transfers 10% of the divisible profits to reserve. So, the next we will take less 10% of profits to reserve. So, 10% of 3,50,000, that is 35,000. So, this comes up to 3,15,000. So, this is profit. Profit available for dividend. For dividend is 3,15,000. Now, from this we will deduct the preference dividend less provision for preference dividend. That is, so 4 lakhs into 12%. So we have the 12% on 4 lakhs, that will be 48,000. So we deduct this. So 3 lakhs 15,000 minus 48,000, we get 2 lakhs 67,000. This is profit for equity shareholders. Profit available for equity shareholders is 2,67,000. Now, the next step is we have to calculate the ERR. Now, we have to calculate the ERR. Now, the calculation of ERR, we need profits available for equity shareholders divided by total paid up equity capital into 100. So, this is the formula to find the ERR. So, the profits available is 2,67,000 divided by total paid up equity capital is 5 lakhs into 100. I get 53.4%. So, this is the ERR. So, value per equity share equals ERR by NRR into paid up value of the equity share. Now, we all know that the equity ERR value is 53.4, NRR is 12% into paid up value is 10. Now, 53.4 divided by 12 into 10. So, this is equal to 44.5. This is the value per share as per the earning yield method. So, the value per equity share is ERR by NRR into paid up value. So, ERR is 53.4 divided by NRR is 12 into 10. So, when we simplify this, I get 44.5. This is the value per share as per the earning yield method. Next is the dividend method. In the dividend method, we have dividend per share by NRR into 100. Now, we have the dividend per share divided by NRR into 100. Now, how do we calculate the dividend? Dividend will be profits available divided by total number of shares. Now, dividend equals profits available divided by number of equity shares. So, this will be What is the profits available? 2,67,000. What is the number of equity shares? 50,000. So, the dividend equals 5.34. So, dividend method. So, dividend per share by NRR into 100. Dividend equals profits available by number of equity shares. So, 2,67,000 divided by 50,000. I get the dividend as 5.74. Now, the value equals, what is the dividend per share? 5.74 divided by NRR. NRR is 12 into 10 paid up. So, we have calculated the value per share. So, based on the earning yield method, I got the share value as 44.5, and based on the dividend method also I am getting the same, it is 44.5. See, by whatever method we do the problem, we have to get the value of the share as the same. So, it should not change. If the value is same, then the answer is correct. But if the value is different, then the answer is wrong. Then we have the capitalization of profits method. Equals. So, this will be equal to 2,67,000 divided by 12 into 100. So, this will come up to 22,25,000. So, value per share equals capitalized profit divided by number of shares. So, 22,25,000 divided by 50,000, I get 44.5. So, we have calculated the value of shares as per the three methods. One is the earning yield method, second one is the dividend method, third one is the capitalization of profits method. So, we get the same value 44.5, 44.5, 44.5. Now, the next problem. Now, we have one more problem here. The balance sheet of Honavar Limited as on 31st December 2009 was as follows. The share capital is 1 lakh, profit and loss account 35,000, reserve 30,000, creditors 45,000, workman compensation fund is 40,000. So, land 70,000, plant 65,750, stock 31,750, debtors 4,750, 47,050, cash 29,250, preliminary expenses. Then next one is the total 2,50,000. Next we have the additional information here. The plant and building are valued at 60,000 and rupees 1 lakh respectively. Out of the debtors, rupees 2,500 are taken as bad. The profit of the company for the 3 years are 34,625, 24,875 and 33,000. The company transfers 20% of the profits to reserve every year. The normal return in similar companies yield 12% and a sales tax liability of 1,000 is likely to arise. Find out the fair value of the shares of Honavara Limited. So, in this, if you can analyze the problem here, so it is a problem based on the net asset value. When they have given you the assets and the liabilities, it means that you have to calculate the value of the shares based on the net asset value, or we also call it as the intrinsic value of the shares. So, you take into consideration all the assets of the company minus the liabilities. So, whatever liabilities are there, you deduct. So, from that you get the net asset value available. Now, here there is a revaluation of plant and building. So the plant and building are revalued at 60,000 and 1 lakh. So whereas in the balance sheet it is given as 70,000 and 65,750. So when there is a revaluation given in the additional information, we have to take these values of the assets. Then out of the debtors, 2,500 are taken as bad. So from the debtors, we have to deduct 2,500. Then profit for the company is given. Then 20% of the profits are transferred to reserve every year. Normal return in similar companies yield 12%, and sales tax liability of 1,000 is likely to occur. So all this additional information is given. So we have to calculate the value of shares as per the intrinsic value as well as on the basis of the yield value. So there are two values we have to find out here. So the plant and building are valued at 60,000 and 1 lakh. So we will first calculate the intrinsic value. So in order to calculate the intrinsic value, so we have to find out the net asset value. So in order to find the asset value, I write the value of all the assets given. Plant 60,000, then building 1 lakh. Next, debtors. So debtors, I have to deduct from, what is the debtors value here? 47,500. So 47,500 minus 2,500. So debtors value is 45,000. So debtors value is 45,000 because they have told that there is a bad debt of 2,500 rupees. Then the next is cash 29,250. Cash 29,250. So we have taken into consideration all the assets. Now we will add all the assets. So it will be 60 plus 1 lakh, 1 lakh 60, then 2 lakh 5,000. So this total will come up to So we have the intrinsic value here. I've taken plant, building, debtors, cash, stock. So when I add all this, I get 2,66,000. From this 2,66,000, I am deducting the liabilities, creditors and sales tax, that comes up to 46,000. So 2,66,000 minus 46,000, 2,20,000. This is the assets available for equity shareholders. Now I will calculate the intrinsic value equals net asset value divided by number of shares. So this will be equal to 2,20,000 divided by 10,000. So this is rupees 22 per share. So the value per share as per the intrinsic value is rupees 22 per share. So this is how we have to calculate the intrinsic value. So the next is we have to calculate the value per share as per the yield method. So first thing is calculate the average profit of the company. So the average profits are, add all this 34,625, 24,875 plus 33,000. So value per equity share as per the yield method. First thing is calculation of average profit of the company. So the total profits for the 3 years is given. So when I add all this, I get 92,500. So average profit I divide it by the number of years, I get 30,833. Now the next step is calculate the ERR, that is the expected rate of return. So the profit available is 30,833. Transfer to general reserve. So 20% of this is 6,167. So I deduct it, I get profit available for equity shareholders as 24,666. So this is the profit available for distribution to equity shareholders. Now the next step is calculating the ERR. So the ERR equals profits available divided by total paid up capital into 100. So ERR equals profits available divided by total paid up capital into 100. So ERR equals 24,666 divided by 1 lakh into 100. 24.66%. So we got the ERR as 24.66%. Now the value per share equals ERR by NRR into paid up value. So this is equal to 24.66 divided by, now what is NRR? 12%. 12 into paid up value is 10 rupees. So this is equal to 20.55. So ERR is 24.66%. So the value per share is ERR by NRR into paid up value. So 24.66 divided by 12 into 10, we get 20.55. So this is the as per the yield method. So as per the dividend yield method, we have the formula dividend per share divided by NRR into 100. So dividend equals profit available by number of equity shares. Now the profit available is 24,666. The number of equity share is 10,000. So when I divide it by 10,000, I get 2.4667. Now dividend per share is, now the value per share equals 2.4667 divided by NRR 12 into 100. So this will be equal to rupees 20.55. This is the value per share. The next one is capitalization method. This is the second method. Third one is capitalization method. Profits available divided by NRR into 100. So for capitalized profits, I get profits divided by NRR into 100. So this will be equal to see, for the capitalization method, we first have to calculate the capitalized profits. So capitalized profits equals profits by NRR into 100. Profits is 24,667 divided by 12 into 100. So this we will get it as 2,05,550. Now the value per share will be 2,05,550 divided by 10,000. So it is 20 rupees 55 paisa. So here also we are getting 20 rupees 55 paisa and here also 20 rupees 55 paisa. Now the next is fair value per share. Intrinsic value minus yield value. Now, what is the intrinsic value we calculated? 22 rupees per share. Now, the fair value per share is intrinsic value plus yield value divided by 2. Now, what is the intrinsic value? 22 per share. So, 22 plus 20.55 divided by 2. I get 42.55 divided by 2, that is equal to 21.2775. So, this is the value, fair value per share. Fair value equals 21.2775 is the answer. So, as per the fair value, we have to add intrinsic value plus yield value divided by 2. So, 22 plus 20.55 divided by 2, 42.55 divided by 2, 21.2775. So, the fair value is 21.2775. With this, we come to the end of this session. Hope you have all followed it. Thank you.